Hi, and welcome to Accounting Academy. I'm Fitz, and this is my dog FIFO. We love to help people learn more about accounting, so join us on our adventures as we dive into accounting topics. On today's adventure, we are helping our friends Ethan and Lisa. They started a lemonade business and are looking for help to learn more about accounts receivable. So let's go.
That'll be $5.
Oh, can I pay you at a later time? That is fine. We trust you, Keith.
Hey guys, how's business?
Hey guys, we could use your help. We just sold some lemonade and they said they would pay us later. What do you call that?
Sure, we call this accounts receivable in accounting. It represents money owed to us for goods or services we provided to our customers.
Oh, okay, that makes sense. But now what do we do?
Well, you will need to collect it at some point, but in the meantime, there's a lot of accounting that can occur.
Can you teach us all about it, please?
Sure, let's start with where it ends up on the financial statement. Accounts receivable, also referred to as AR, shows up as an asset when a sale is made and cash has not been collected. You can see it here on the balance sheet.
That makes sense.
Okay, but what happens when we collect the cash?
You would simply debit cash for the amount and credit AR. You are now no longer owed that money and have collected the cash, so the entry eliminates what is owed and shows you the new cash collected.
Got it, Fitz.
Okay, but what happens if we don't collect it?
Good question. You really have two options, but both will hit bad debt expense. So for example, if you know Keith can't pay you for the lemonade, you can directly write off his receivable with the following entry: a debit to bad debt expense and a credit to AR. This shows up as a negative on the income statement and wipes out the accounts receivable amount.
Okay, what's the other method?
The other method is the allowance method.
How does the allowance method work?
When you are estimating your uncollectability and are uncertain, you create an allowance against your AR balance, representing the net balance expected to be received. Let's say you are uncertain on a portion of your balance of AR. You can create this allowance by debiting bad debt expense and crediting allowance for doubtful accounts. This amount is shown net against your AR balance.
What happens if we later find out those estimates were correct?
Once it's determined to be uncollectible, you would write off that AR and allowance for that AR through the following entry: a debit to allowance for doubtful accounts and a credit to AR.
Gotcha.
Okay, but how do we determine the amount of allowance to create?
Good question. Technically, we would follow the CECL accounting method.
CECL?
Yeah, CECL stands for Current Expected Credit Losses, but for simplicity purposes, you typically would create and follow a policy for your company. Each company would have specific inputs into the policy based on their industry, AR history, customer creditworthiness, and other similar factors. A lot of times, companies create a policy and apply it to their AR aging balance.
Can you show us an example of how to apply this aging policy?
Let's take a look at this AR aging schedule I found to use as an example. You can see that the total AR balance is $27,500.
Oh, and they've spread out each customer's balance by age. So for example, Apple has $8,000 total and $5,000 is current, but $3,000 is between 61 and 90 days old.
Yep, that's right, Lisa. Now let's make up a policy. That current through 60 days is expected to be fully recovered. That 61 through 90 days has a 5% reserve against it, and then let's make it a 20% reserve on things over 91 days. That math works out to $875 in total, so that should be reserved in the allowance for doubtful accounts.
Okay, but what about the entries?
Good question, Lisa. Let's add a wrinkle to this and say that as of last month, your allowance was already set at $500, leaving a difference of $375. Therefore, our entries are a debit to bad debt for $375 and a credit to allowance for doubtful accounts.
So that increases the balance sheet allowance up to $875.
Yep.
Thanks, Fitz. I think we understand receivables now.
Yeah, now we just gotta get Keith to pay.
Good luck with that, guys, and good luck with the business. Alright, folks, thanks so much for watching. Please like, share, comment, and subscribe. And if you can, donate at Patreon. Anything you can give helps to keep the lights on and ensures we can continue to create content. And of course, helps feed FIFO. If you want to contact us about anything you saw in this video, accounting advice, or ideas for future videos, contact us at patreon.com/accountingacademy.
This video is designed to be illustrative and does not represent an official position. We make no representations, warranties, or guarantees and assume no responsibility for the application of this material. Please seek advice from a competent professional if expert assistance is required.